Now let's bring in CNBC contributors, Capital Area's Malcolm Ethridge and 314 Research's co-founder Warren Pies. The professor, of course, is still with us. Warren, you first. You have somewhat of a run-it-hot target for 2026 in the market, 78.50. We're getting another 1,000 points out of this S&P from you.
Yeah, thank you for having me. I think it's hard to be to construct a bearish case on the doorstep of 2026. You know, you have, as you discussed with the professor, you know, most everybody, even the dissenters, are expecting cuts next year. We have, I think we're going to get 12 to 13% earnings growth. That'll be the best earnings year we've seen since 2021. And part of that is we're going to see margins expand. And I think that's key to our outlook and how it distinguishes itself from most of the strategists out on the street. We think, contrary to the consensus, that multiples will actually expand next year. And so that's how we get to our target. We're also in what I would call a recovery backdrop. We already had an 18+% decline 8 months ago. You go back in history, there's only one case where you get another one of those types of really serious corrections over the next 18 months, and that was COVID. So it takes some kind of really serious exogenous event. So I put all that together. I just don't know how you can be very bearish at this stage.
Wow. That makes sense to you, Malcolm?
Yeah, I don't disagree. I think it's very telling that the professor started off the conversation talking about valuations, and companies that are 30, 40 times earnings might have a tough road to hoe next year, which does say something about the broadening that you guys are discussing. I think the AI trade continues to roll, and I think that maybe we start to place our bets with companies that have a little bit more going on than just spending to build out their AI infrastructure. So if you think about an Alphabet, for example, an Amazon, or Microsoft, they've got well-diversified revenue mixes that don't just rely on leasing out cloud servers and those types of things, and can appease shareholders along the way while they build out. I think that's more likely the tech trade that carries the narrative next year, but I also think that there's definitely room for a lot of other sectors to participate in a way they haven't in quite a while.
Professor, 1,000 more S&P points for next year. Does that make sense to you?
Well, that would be 15%. I'm trying to do the math over here.
15. Yeah, it is.
You know, that would be on the high, not impossible. Listen, the Fed, you know, raised its estimate for GDP growth next year by the biggest amount that I've ever seen outside of coming out of a recession, which we're not in. I mean, you know, by 50 basis points, it shows how much they have raised their forecast for growth, and it's certainly its growth and its earnings and its margins that drive stock prices. All three are in a positive thrust right now.
You know, Warren, I'm just curious if you think we are on the cusp of a legit trend change in this market. Run it hot, go cyclical. There's going to be AI concerns for the foreseeable future, right? Any little blip is going to cause consternation somewhere. So if you're going to run it hot, especially into the midterms, let's run with what we've got here.
Yeah, I think that everyone's wanted to see this broadening for years, really. And my view is more like Malcolm, which is that there is going to be broader participation. Look, this has been three of the narrowest years going back over the last 75 years. This is three of the five narrowest years on record, meaning we've had the fewest number of stocks beating the index. And so I think you will get a broader, and we've only had three sectors, including the two tech sectors, outperform the index. So you get a broader move next year. And I think we're set up more for this continuation of a Goldilocks period, say the first quarter, maybe the first half of the year. But I do think the run it hot, commodities, cyclicals trade starts to take over in the second half of the year. And that's commodity positive, bond negative, and more choppy for the second half of the market.
It's interesting you talk commodity positive. You know, Jeffrey Gundlach telling us, Wednesday after Fed Chair Powell was done, that he's pretty bullish on the commodity space. What about that, Professor? I mean, the dollar has
heard
been
Jeffrey
certainly weaker,
on
right?
that. He thought the dollar was really going to go down, and I think he thinks there's just going to be too much excessive cutting next year, and I just don't think that's the case. I mean, go down another 50 basis points. I mean, you know, get that curve 100 basis points steep on the term structure. That's a healthy market. That's not a necessarily inflationary market. I think Oil is 57, the most important commodity. Gasoline prices just, I think, hit a 3-year low on average yesterday. Copper's a hot area. There are a few hot areas. But I really don't see a general commodity inflation in 2026.
Interesting. Malcolm, I'm going to let you finish it out with, reminding people that you sold out of Oracle yesterday. Maybe you're feeling good about yourself today. The timing seems right for a stock that's down in total almost 13% this week. What do you make of the news that crossed today, even with the denial from Oracle?
Well, in all seriousness, I don't love it just because it's not great for the entire ecosystem, right? I am very bullish on the AI trade, and I'm not a short seller, so I don't have a vested interest in any one company doing poorly against the other. But I do think that the timing of this is not great. The air is being let out of this balloon, so to speak, at a time where you started off the conversation with Alex pointing out that there wasn't a lot of room for error with all of these different tech titans who are helping to steer the AI narrative. And I think it's very telling if you rewind back to the information's reporting on Microsoft's reasoning for why they decided not to tie their entire fates to OpenAI when they obviously had the chance as the first mover there. I think that's very telling as to what the underneath the surface looks like with relation to the spending commitments here with OpenAI. And so for Oracle, I think it's probably not the right time for anyone looking to be saying this is where I want to buy the dip or I want to step in here and start to initiate a position. I think you're more than likely to get a much better buying opportunity in this name over the coming days.
All right, we'll leave it there. Good weekend, everybody. Malcolm, thank you. Professor, of course, Warren, to you as well.